Hi, and welcome to From the Research Chair, a Focus Consulting Group podcast. I'm Jason Voss, and
I'm Michael Falk. Hello, all.
hello, all. We're going to be talking about a subject today that is quite a passion for both Michael and me. Michael, say a couple words about it, and then I'll tell my story about it. And of course, the subject today in episode 6 is risk.
Well, some people know I have this attitude. Listen, we don't use any four-letter words on our podcast. This is a polite podcast. But today we're focusing on a four-letter word. And maybe that should trouble you all, or at least signal where we're going to go in our talk about risk.
Well, yeah, it is a four-letter word for me. It is something I'm quite passionate about, and I like the Italian version of the word passion. It means to suffer, or the Latin root of that means to suffer. It is a passionate topic for me. I care about this subject so much that, and I know, Michael, I'm not trying to trump your interest in risk, but I did my master's thesis on this subject because I thought the investment business's definition of risk was a little bit askew. Any other comments? Otherwise, I'll dive into the origins.
Yeah. I want it table stakes. Let's at least put a definition out there, right? Risk. More things can happen than will. Can we just lather in that, right? Enjoy that. More things can happen than will.
That's a pretty good one. There's a hidden probabilistic sort of quality to it without necessarily showing the shape of your distribution, which I know we'll feature here. I'll put forth my own definition as simply the chance of loss, which also.
Well, you're so negative. It could be a good thing.
Well,
negative, Jason.
Yeah, I'm not sure I agree with the good part, but we'll get there. By the way, for those of you who are new to the podcast, Michael and I, who work together quite frequently, we love where we overlap, and we also celebrate and love where we disagree. We're friendly disagreeers. So the risk origins story, this is something that I cover in the book I co-authored last year, Return to the Active Manager. I have a quote. I've also written about this quite extensively. Where does this definition of risk as volatility, as variance come from? Most of you probably know the story. You may not know the specific language. The origin is it comes from Harry Markowitz, who first put forth his version of the efficient frontier and security selection and all that good stuff in 1952's portfolio selection, for which, of
course. You mean to imply that risk didn't exist before Harry published?
That is exactly what I think finance believes.
Ah.
However, my friend, here's what Markowitz says. I don't know that any of you have ever read the actual document that won him a Nobel Prize. I know that many people have not. They just know the theory is represented in either a CFA program, MBA program, or portfolio management book. So Markowitz says the following, and I think very blithely and sort of unconsciously: we next consider the rule that the investor, or should consider expected return a desirable thing and variance of return an undesirable thing. We illustrate geometrically relations between beliefs and choice of portfolio according to the expected returns variance return rule, end quote. So what's fascinating about that quote to me is, in a single sentence or two, he has laid out a framework that we are still living with 68 years later and is largely unupdated. And what's also interesting to me is he uses the word variance. His ultimate point in this whole paper is not about the proper measurement of risk being variance. In fact, he's borrowing linear regression terms and statistical terms in order to make a larger point, which is that diversification is a good thing, and that it's possible to earn the same return with lower variance of return over time, which I think, Michael, you probably agree is a good thing.
I do. And variance, you mean more things can happen than will?
Well, indeed. But here's the second interesting thing.
I will use other words on this podcast just so everybody is prepared.
Yeah, of course. And maybe more four-letter words given the nature of the material. So the other thing that's interesting to me about Markowitz's language here, and we have to remember, he was young. He was trying to carve out a niche within a space. He thought he had an interesting idea of using mathematics to prove out his point of don't put all your eggs in one basket being an acceptable thought. What's interesting to me is kind of the we'll chalk it up to the young male trying to prove himself kind of way. He calls this the expected returns variance of return rule. Well, guess what, folks? That was a term that he invented literally in that paragraph. Didn't exist before then, but he anoints it as a rule, as a twist of language right there. And here we are in 2020, still stuck with variance and standard deviation as our financial definition of risk.
You say that like listen, if you get to make a rule, can we all just admit that's not a wholly determined bad thing? Now, of course, we don't know if your rule is going to be accurate or not, but if you can make a rule, go for it. Make a rule.
Michael, well, that may be a whole subject of a podcast, which is Michael's rules, Jason's rules, especially given that I haven't been able to excavate from you good answers to our pet peeves section at the end of the thing, which is maybe rule territory, my friend. Anyway, we digress. Never mind the fact that investors do want variance of return to the upside. So, Michael, talk to us. Is this definition of risk appropriate for the task at hand?
I'm going to use a 2-letter word this time. No. So I'm going from 4 letters to 2 letters. Pretty soon, I'm just going to turn off my video and go away, which maybe some of you are wishing for at this juncture. But the point is, if you're going to use math to describe reality, oh my, it works when we're talking about physical constructs, like gravity, because this is tested and proven over and over again. But investing is a sociological, biological, anthropological, I'm done with logicals. It's not nature. It's human nature, and human nature ebbs and flows. There's not a consistent rule that always applies. So no, we cannot bring math into this realm.
Yeah, and it's an interesting point. Michael, you know that I'm currently writing a series on behavioral finance, and I want to land on a theory of behavioral finance. And then you and I are on a future From the Research Chair going to debate what we believe behavioral finance boils down to. We have some disagreement there. But that theory of behavioral finance is a psychological theory. And in order to shape that theory, I looked at and researched what constitutes a theory, and there's nothing in there about mathematical precision. In fact, there are many theories that science contains that don't need mathematical certainty. So there's a certain interesting moment that was captured in 1952, Markowitz's story, to the early 70s when Bill Sharp and Littman first put forth modern portfolio theory, CAPM, and all of the things that we're stuck with in quote unquote modern finance. And one of the interesting predilections, and I'll chalk it up to a sociological predilection, was that the squishy sciences needed mathification. In fact, the CFA program, I used to work at CFA Institute, is in fact an effort to quantify the skills that are necessary to be a great investor. We have to remember that. I think, Michael, that's an important point. It was a moment in time and in human history when many of these soft sciences were trying to make things mathy, including psychology.
Well, listen, there is nothing wrong with and everything right about trying to understand more. But when we try and describe something that doesn't fit the description, we should just stop. And if we just look at the S&P 500 for just a second to go into the math, right? We've got mean, standard deviation, second movement, third movement, skewness, fourth movement, kurtosis. When we look at the shape of that statistical profile distribution, the S&P 500 is not normally distributed. If it is not normally distributed, that means that all of the math to describe the distribution as normal, i.e. those moments I described, they all fall away. We can't use them. Folks, this is the drunk looking for the keys they lost in the field on their hands and knees by the lamppost, because that's the only place there is light.
Yeah, and to that end, I've actually got the data. It's 3 basis points per day up is the mean for the S&P 500, and the standard deviation of return, daily return, is 0.98. So it's close to normal, but not really. But not only that, just we don't even need a mathematical argument to consider this issue. One of the things I did for my thesis was I researched other organizations, other institutions, other places where risk is central to discussions and looked at their definitions of risk. Every single other entity other than finance defines risk as something approaching what Michael said or what I said, the chance of loss. Only in finance do we consider it a symmetrical thing where upside is something to be avoided as well as downside. I think all of us on the podcast today would agree that in investing, we're trying to get upside for God's sakes. And in fact, that's an outstanding thing. Okay, so back to Markowitz, back to Sharpe. Why did they make this choice? Well, they were trying to make larger points, A, but then B, something that is, I think, lost in the mists of time. They were living in an era where slide rules were how math was done. There were not even calculators that were inexpensive enough to be able to calculate these things.
Wait, you mean context matters,
Wow.
Jason?
I do mean context matters.
Oh, it's just shocking. This is
So
absolutely shocking.
We have beta in cap M along with alpha, terms we still use today to describe things as borrowed concepts from statistics, because guess what? Relatively speaking, they were complex, but still calculable within one day. And so I think that that means we can afford to update things, and we should look at risk, I think, how it's properly looked at, which is, Michael, I think you would agree the downside is much more interesting.
Well, I'm gonna get a little bit more candid. Jason and I, we're aligned on our definition. So let's change the supposition for a moment. People who invest money, could we at least argue that most of them are investing for a purpose, for a goal, be it an endowment, a pension, a person saving for their retirement? There's not a lot of people who are investing for pure sport. All right. If you just allow me to extend this for just a moment, if most investors, not speculators, most investors are investing for a goal, then why are we not simply defining risk as falling short of the goal? If that's why they're investing in the first place, then risk should simply be defined as they don't get there. Should it not, Jason?
I am in 100% agreement. Currently working on a second edition of the Intuitive Investor, and I say all risk flows from a decision, and that decision is, what am I trying to maximize? And then the risk happens as soon as I planted that flag. I may not achieve the flag, and by not achieving that, it's exactly what you've just described. I think that's
and so now let's take another stupid term in the industry: tracking error. So tracking error is to a benchmark. What if I actually recast tracking error as tracking error from your goal? Now we can actually use that term in a productive fashion, not a waste of time. Is where are we relative to our goal, and what do we need to do to increase the probability that we're going to be able to achieve that goal?
One final comment on the definition of risk, and then let's talk about the consequences of finance's very peculiar choice to honor Markowitz's initial work and Sharpe's work. Beta also, by the way, is a symmetrical problem. It is also a symmetrical math problem. It is the slope of a line based on variance in data that you get to the calculation. One last point on the definition of risk. There's one industry, happens to be one of the oldest industries known, no, not that one, which is the insurance industry, which is entirely obsessed with risk. It's been around for approximately 400 years. And guess how they define it? Essentially, the chance of loss. Actuaries don't spend any time on the chance of gain in assessing risks and pricing risks. They are literally in the business of pricing risk correctly. They do not use upside. Only in finance do we use this odd terminology. You're smiling.
Well, I'm just wondering if, Jason, you just called all of us finance people odd.
I did. Those who are not drinking from our Kool-Aid, right? This is my rule. Please, I'm making my first rule. Please do not use standard deviation or beta in assessing risk. They are incorrect measures.
Or tracking error.
Or tracking error. They're incorrect measures of
We
risk.
can keep this list going, but we'll just use the big three.
Yeah. So, Michael, you already have revealed one of the consequences of choosing as definition of risk volatility around a mean or fluctuation around a line. What are some of the other consequences of defining risk in this way? How has the industry evolved using those concepts as bedrocks?
Well, the simplest one that jumps to mind, Jason, and I'm curious, we haven't talked about this, so I'm curious what your reaction is going to be. You were lucky enough to buy a stock as an example. Please excuse for people who invest in other asset classes. Those still exist? No, that's a separate topic. You bought a stock and it went up, 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 up. And you feel that you need to start trimming it back or selling it because you're afraid of the amount of risk that you are now taking. Now, yeah, you may have increased your concentration risk because of the demonstrable success of one position. Absolutely. But why is it that people get so nervous and so troubled by immense profits? I had a conversation yesterday with someone who bought Tesla early, and they are petrified about what they should do with it right now. Jason?
Well, Michael, I had not thought to relate it to that. What I would argue, though, somewhat tangent to what you've said, is that risk, the way it's traditionally thought of in finance, should be divorced from the decision-making process as implemented. It has no place. And it's mostly used at portfolio management. We have good data that portfolio management is a subtractive activity. In fact, we talked about it in our portfolio construction podcast, which I believe was episode 3. And we put forth data that shows that security selection adds 280 basis points of return. You subtract out 75-ish basis points for expense ratio. So what explains how it is that active management is a negative activity? It's from portfolio construction. And sadly,
so they can pick them, but they can't manage them?
They can't weight them. They can't aggregate them. And now we're pointing... Sizing. And now we're looking squarely in the face, portfolio selection by Harry Markowitz. And now we're squarely looking in the face of Bill Sharp. Said another way, there's something broken here. And my point is total return over some time period chosen by the investor is really all that matters. And Michael, you're fond of saying, I'm fond of saying, you cannot eat risk-adjusted returns. Go ahead.
I'm not only am I fond of saying it, I'm also fond of saying where I stole that from, because I wish I said that, but I didn't say that. I'm certain more people have said it, but Jack Bogle, the father of modern indexing, do you think there's a correlation between someone who just allows survivorship bias to run rampant and somebody who says you can't eat risk-adjusted returns?
Yes. So here's the data. Here's the data on modern portfolio theory, CAPM. The holes in the theory were almost immediately pointed out by many. The theory goes that you can only get higher return by taking on greater risk. And that's just not borne out by the data. In fact, consistently what's found is lower risk, lower beta, lower standard deviation assets tend to outperform over the long run. And so it's an inverse relationship, not a positive relationship between return to risk. And that's quite shocking to many people. Yet we continue to teach this hokum. I'm not sure why. It's not supported by data. It's logically incoherent relative to our daily experience of risk. And now you can see why Michael and I are frustrated by this concept. One final consequence we have not discussed, the style box. Tracking error, I know, is somewhat tangent related, but the style box has so many unintended consequences. I will mention one of them. One of them is that managers have turned their attention away from all of the universe or fishing pond to which they can deploy their ACE security selection tools to this narrowly defined little tiny box. And they are happy with that definition because they want to acquire assets and so they can charge a management fee. But that style box has as its roots modern portfolio theory and the way it starts to parse return and risk. Said another way, value is seen as less risky, growth is seen as more risky in terms of that spectrum. So the style box is an artifact of this bizarre thinking, and the whole industry is structured around style box, style constraints, tracking error. You get punished by Morningstar, you get punished by plan sponsors if you deviate. So this is another consequence. Michael, you're...
Well, yeah, Jason I'm listening to yourself. I'm listening to what I'm saying, and I'm struck with a question that some of our guests might have on their mind. So what are we supposed to do?
Dun, dun, dun.
If we agree with all the trouble you two are brewing, which seems to make so much sense, what are we supposed to do?
You answer first.
Well, if we think of risk as unintended consequences, let's recharacterize just for a moment, meaning we don't get what we thought we were going to get. Right? In kindergarten, we're taught a simple rhyme. You get what you get and you don't get upset. Now, that doesn't seem to translate very well into the investment world, so it just needs to be mentioned. You invest in something and it doesn't go as planned. First thought, sell it. All right, now absent selling it, because I know there are some value investors who still exist in this world, they want to buy more. Fine, buy more. But start to track whether or not that was a good decision. And if it drops again, blow it all out. Don't keep averaging down. You got something wrong. First step is to admit you have a problem. All right, so once we get past sell faster, now let me go to the other side. Buy slower. So your buy decisions, nobody is rushing you to allocate capital. And if they are, run away from them. Buy decisions should be made slower. Leverage cognitive diversity. Build a team of people who don't always agree with you, who don't necessarily think like you, and have proper debates. Buy slower. Sell faster. So there's only one more piece to this little puzzle here, Jason, and that's how do we size things? Well, since we don't have a clue about the future, right? Future facts haven't been written yet. Then unbias what you own and own everything equally. And some of you on prior podcasts would have heard that from me. Buy slower, size equally, sell faster. And I would argue that you have done a better job of managing this four-letter word called risk than any other single thing you could do.
What I love about your answer, Michael, is Michael and I have had different roles in the business. I was research analyst, portfolio manager, partner. Michael has similar roles, but was CIO. He's just giving you the CIO view of this problem. My own view, my own way of operationalizing these insights is to look at the risks that individual securities face themselves. If you are a fundamental investor, and many active investment managers are, including the growth ones, your assessment of management team is in part an assessment of their ability to manage risks on your behalf. And so your job as analyst, and this was one of the ingredients in my secret sauce for the results that I delivered, was to create a set of categories of risks that businesses universally face. So I almost took an insurance company's point of view of this, and then I assessed company's ability to manage those. So what would be one? Succession would be one. Current CEO, I love the CEO. Well, then guess what? There's a risk that you've just identified. Per our definition earlier, you have a preference for the CEO. The risk is what happens if the CEO retires, dies in a helicopter accident, which happened to be with one of my portfolio companies, so on and so forth. Environmental risk would be another. ESG factors these days would be included in some of the things that I used to evaluate as possible risks. Another insight.
Jason, you're saying know what you own.
Know what you own.
And know what you own.
Yeah, and here's a tip on how to do that. One of my questions, tricky questions for candidates who used to want to work for the Davis Funds and work for me was, talk to me about where you can find the risk factor session in the 10K. What item number is it? What item number is the financial statements? It's item 9, by the way. Anyway, if they couldn't name the item number within the 10K where the risk factors resided, I knew that they didn't do fundamental analysis. They relied upon some other means. My point is that companies have very nervous legal departments. They have very nervous investor relations departments, and they think and they brainstorm and they update their list of risk factors that they are confronted with, because if they do not disclose, they're subject to lawsuits from shareholders. And that is a great starting point to begin building the true risk factors that as an investor you ought to be concerned with. All of them are denominated though by chance of loss. Things may not go as expected.
And they all seem to be qualitative, Jason, from what you're talking about. Maybe you can assign some numbers to some of them, but by and large, they're qualitative.
Well, yes and no. Here's the disagreement. The insurance company has long histories of probabilities to individual risks. I would argue the following. The set of risks or the suite of risks that businesses face tend to repeat themselves over and over and over again. Opportunity, by definition, is something that hasn't happened yet. Now, it could be that you sell more product to the same customers. It could be that you raise prices, but those are all prospective decisions, and they, by definition, are open-ended problems. Risk, I tend to think, is a closed system for the most part. There are black swans, but most risks are easily identifiable. They're easily managed. They're easily managed at the individual security selection level, and they're well managed at the portfolio level too. I won't quite reveal how I used to do it because that is value-add consulting information for me. But yes, Michael, I think they are qualitative. The assessment of them is certainly qualitative, though we can rely upon probability, which is the furthest math has gotten to introducing quality into quantitative analysis.
Yeah, and again, folks, you have control here, or if you're a member of a team, you've got partial control. If security is moving incorrectly based upon your work, isn't that a fun word, incorrectly, based upon your work, you always have the prerogative to sell it. Now, mind you, I am not an advocate of turnover. I'm an advocate of what Jason highlighted earlier. You have shown evidence that you can pick them, that you can select good securities. The evidence exists. You just can't manage it. You know, part of your problem is you're managing it too much. Do less, right? If you size equally and just let them grow, if there's no accident, nothing behaves incorrectly, you don't have to sell it, then let it grow until or unless it hits some concentration risk for you, or the price is so far distorted from reality, in your opinion, you're losing sleep because of the success, then maybe it's time to reduce.
So, Michael, I've said just about what I need to say about risk. As you can tell, we reject the modern portfolio theory version of risk as inadequate. It's non-descriptive. It's also not supported by the data. So those are pretty damning, but still it persists within our industry. Part of our work that we do, Michael, with organizations is we try and advise them to get off of this discussion and instead to look at other things. But it has sadly become an existential issue because our industry's foundations are built on these concepts, and it's been done at scale, and a scale to such a degree, it's really hard to unwind and get back to reality. Here's the encouraging but devastating news. The market doesn't care about our preferences on these issues, and it continues to deliver great results for those willing to divorce themselves from these concepts. That's my final comment before we turn over questions. Michael, what would you like to share?
Well, we ask, when Jason and I do deep work with investment teams on their decision making, that's our day job. We ask the question, what are your favorite definitions of risk to all the team members on an investment team? We put up a polling or a voting slide, and we list an aggregation of what we hear from the team members. We bring that back to the team, and we say, pick your top 3. As an example, we show 10 different definitions, pick your top 3. And what I'm fascinated by is there's rarely alignment, if ever, number one, on the top 3. There's a massive dispersion, on how people like to define this. Well, if you on your own investment team aren't defining this similarly, do you think maybe we have a problem? So that's why we ask, and then we help them to try and understand. What's been going on lately is fascinating to me. We had one team who denied a few definitions because they said, that's not our problem. To which Jason and I just got very curious. What do you mean that's not your problem? Well, that's a business-related risk. That has nothing to do with the investment process. To which Jason and I could only look quizzically about, if the business has risk, that means you have risk. Shouldn't the definitions connect? How can that be somebody else's problem and not yours? So I just want to close with those words. Folks, when people give you their money to manage, first and foremost, they want to be able to get it back. Second, they'd like to get it back with a little extra, sometimes maybe a lot extra. Well, I don't know if they're greedy or not. But the point is, that's not just a business risk. How are you managing your investments to accomplish that? Because there's connective tissue there. Those are a couple of my final thoughts I wanted to share.
Yeah, and Michael, you're saying that and sharing that anecdote. The other thing that we're seeing in our work, which is increasingly interesting, is the private-public discussion about this. Many investment teams don't use standard deviation. They don't use beta. They do, some do, but internally they don't use it. It's only for external comms because they know people want it. So in a certain way, it's kind of like, I think there's a growing understanding of this. And I almost feel if somebody bold and brave said something about it and made money, ignoring these concepts, we might all give ourselves permission to acknowledge that these concepts are broken and that they've resulted in an industry that's not serving end clients, which I think is ultimately what Michael and my concern was with this client, is that they were ignoring client outcomes in favor of their own definition of risk. In other words, that their clients were losing money was irrelevant to them, sadly.
And it wasn't losing money absolutely, it was losing money maybe relative to. I just want to be careful about that. They weren't losing money.
Yeah. Their definition of risk did not include the client and his or her outcomes. So we had received in advance of this conversation today several questions via email. You can always do that. While we are
hearing from you.
And we do. What's funny is when we're on the podcast, we query for questions and query for comments. We rarely get them, but inevitably on every single one of these podcasts, we receive comments after the fact, questions after the fact, questions ahead of time. So you are listening, you are curious. Not sure what's driving that, other than
use
that maybe
the chat box.
Yes, I was going to say, if you have questions or comments, use the chat box while Michael and I proceed to answer these 3 questions we received from two questioners. The first question came from, and I won't identify the person in case one of the issues at hand here is emotional safety, and people are uncomfortable asking questions in front of their peers. The question was, how do you best assess risk tolerance for private clients prior to investing with the investment group? Not quite sure what's meant by the investment group there, but I can guess. Michael, do you have an answer? And then I'll provide mine.
Well, I have a couple answers nobody would like, so let me start there. Allegedly, there is a blood test that everybody can take that will actually get into their ability to tolerate variance. But then people say that, well, that's invasive, and then we got privacy issues, so don't go there. I used to joke that before anybody is allowed to make investments, traders and the like, they have to do a spit test, because you're in your saliva, we can measure the level of testosterone. If you're too hopped up on testosterone, no trading. All right, so let's get past those. We have to have a little fun. It's a podcast, right? All right, so what do I think in terms of how do you measure individual? What I actually would prefer to do, because I don't think these measurements are consistent. I don't think they're stable. I don't think they have a lot of efficacy. In lieu of that, measure each of the personality cognitive thinking styles of the members of the team. If they have different or diversified cognitive styles, and you're making the decision as a team, you've got good structure to how you make a decision. I don't concern myself with any individual risk tolerance. I concern myself with the diversity of the team's cognitive profile, and I concern myself with how they structure debates and make decisions, because then I can diversify whatever it is that is inconsistent and difficult to measure.
Yeah, my answer is somewhat similar. I think the question, the context, I could be wrong, was at the private wealth level, right? So, financial professional, not financial pro. And my answer here is, I think, obvious based on how we're defining risk here and how I stated that as soon as you plant an expectations flag, you've created the risk that isn't there if you're surrendered to other outcomes. So conversation and having conversations with your clients are absolutely key, especially around expectations. Rather than, typically advisors will lay out expectations without asking about expectations. Now they may ask about financial goals, that's different. Financial expectations are, okay, I'm going to work with you, and in so doing, I'm going to be able to achieve those goals. But the expectation is, some level of transparency. You're going to do your due diligence. You're going to advise me professionally and as a professional, so on and so forth. But some of the expectations that aren't often asked about include things like, well, I really get uncomfortable when the stock market goes down, and I have an expectation, please don't lose me money. I have a story around that, which has something to do with the fact that my father always, whispered in my ear, hey, in the Great Depression, we lost everything, never invest in stocks. Like, to have dialogue around where the expectations are coming from, as well as the patterns of behavior around money, is huge. But there's also a quantitative story here as well. Look through the past financial statements if you're dealing with an experienced client, one that has at least 5 years of trading, and see how they reacted and responded at different market cycles and market times. And that will be a quantitative story if it exists. And for example, in 2013, when the Greek financial crisis reared its head, the US was past the dips of 2009 in its global financial crisis. How did your client respond? Did they sell out of everything? Did they trim? Did they add? Did they rotate into this mutual fund and out of that mutual fund, into this ETF, out of that ETF? That will tell you a lot about their risk tolerance rather than a single number. Michael.
It's also about context. And this is a longer story, but let me share. In November of this year, so in a couple of months, I wrote a lengthy article about investing. Risk is a part of it. And it's going to be published in the behavioral issue of the Income and Wealth Monitor magazine. So stick with us over time. And when that's published, I will probably be able to provide you a link to get the article. I think it tells the full story, because Jason, everything you said, spot on. But context shifts over time, right? In 2009, they may have been 10 years away from retirement. Now they're facing, can I retire? Do I retire? And so context is always critical in this question. So on behalf of Jason, we hope we covered that one question sufficiently well from different dimensions.
Yeah, I will amplify what you said, agree and amplify. Other contexts that are important are lost job, right? 2 lost jobs, death of spouse, eviction from home, right? You know, name, we could go on and on. Context is key, and check-ins are key to be able to understand that. Next set of questions, both from the same questioner. The first is, how measure the unsystematic risk? Michael, I think we've gone a long way to answering that on this call, but do you have anything that you want to draw out specifically?
What if we don't try? I don't mean to be facetious, unlike some of my other responses. My question back is, what if we don't try? Meaning, you buy the securities that you think makes sense to own. And again, you do the work that we talked about, buy slow. You don't bias what you own. They're sized equally, at least upon purchase. And you have a better sell discipline, how to deal with losers, how to deal with winners, a two-tail sell discipline. Do we care about unsystematic risk? Or maybe said another way, without unsystematic risk, then we don't need active management. Oh, we like active management though, I thought.
Yeah, I think we've answered the question on the call. First thing is, the concept of unsystematic versus systematic is a beta concept, and it comes from Sharpe. It's not supported by the data. Probably not worth measuring, I think would be my answer to the question. Businesses face a whole suite of risks. Some are firm specific, but great management teams of businesses are managing the external risks too, including the political environment in which they're operating, where their headquarters is located. Is it located next to the Mississippi River and it will flood and wipe out their manufacturing? Great management teams are managing both the systematic and unsystematic risk. And if you have a good risk process, risk evaluation process for individual securities, it's already built in. So the concept is, said another way, the question itself, I kind of reject on principle because I think it's not a valid question. Not the questioner's fault. You're entirely forgiven. Don't feel foolish, because 99.95% of the dialogue in our business is around these concepts.
Yeah, you're staying within the confines of what the industry has defined. We're trying to stretch outside and make more sense of what is usable and functional.
Yeah, next question from the same questioner. Beta is affected by financial leverage. Shouldn't we unlever?
Well, let's talk about leverage vis-a-vis risk. It's really hard to go bankrupt if you never borrow money. So, by definition, then, if we only remember that fundamental detail, less leverage is less risky than more leverage, right? And, you know, I kind of like to look to Hyman Minsky a little bit about this. And Hyman Minsky had his 3 different levels of quote unquote risky finance. I really think we want to understand our businesses that we wish to own unlevered. How efficient are they with capital? I think this is a really important topic.
Yeah, I agree. And at the heart of the question is sort of cost of capital, right? And should leveraged businesses pay a higher cost of capital, which runs contrary to modern portfolio theory, right? So modern portfolio theory, ironically, because of the way these things are built, the cost of capital are built, a firm that has higher debt levels will have a lower cost of capital, but it ought not to, because essentially every time they take a dollar of leverage, they're reducing movement, their chance to respond to the operating environment, and relative to what is necessary in order to keep the business sound. Instead, they're responding to another constituency, which is bought into the financial statement or brought into the financial statements as soon as they do that. And their debt covenants and debt holders' concerns, so on and so forth.
So they're encumbering themselves. Is that a way of putting it?
Absolutely. And sadly, in the COVID era, I think many households who are overly levered have realized the same fact. So yes, I would argue that leverage is a risk factor and that the cost of capital ought to be higher for higher leverage. How you do that is entirely up to you. CFA Institute, it's funny, I used to say I took away several quantitative tools that I appreciated as a CFA charter holder. One was Hamada's equation. Hamada's equation gives a very simple calculation for how you can increase the cost of capital to reflect higher levels of debt to equity. That said, I think that cap M and the cost of capital that it creates and derives don't have any real close relation to how markets actually price risk. There are other ways, but that's more of my secret sauce as an investor that I don't necessarily want to disclose here. Are there any other questions? I know, Kate, you had a comment. I want to make sure there wasn't a question in there. Kate said, managing risk for clients, isn't there an element of communication required? How does the client think of risk? Kate, I think we almost answered that. Michael,
let me go a little bit deeper from a private wealth standpoint. You know, we used to think of risk tolerance as just one uniform thing. All right, then we evolved a little bit and we said, no, risk tolerance is a combination of two things: risk preference and risk capacity. And there's a paradox here. So risk preference would be, how well can you sleep at night if, just for clarity. Risk capacity is, how much money do you have and what are your goals? How much money do you need to satisfy your goals? It's an actuarial style type of math. Well, what's really interesting about this is, all right, we have more clarity on what risk tolerance is made up of, but we don't have any more clarity about how to mediate between these two things. What if someone has immense risk capacity because they're 25 and they're simply talking about saving for retirement? But their risk preference is the stock market scares the bejesus out of them. How do you mediate between the two? So Kate, to come back to your question, that's a dialogue. And I mean a dialogue. That's an extended conversation to help understand how they would actually mediate between those two pieces of the definition, which actually can be in quite conflicted territory at times. Usually when they are most conflicted is at some level of a turning point, right? Right? Just about when you can't take it anymore is when the market's about to turn around. How many times have we all seen this demonstrated with investors? So Kate, I hope that gives you a little bit more of a response that's functional and usable.
Yeah.
Oh, I got a thumbs up. I should hang up now.
Thank you, Kate. Kate's done with lunch. She put up the thumb. Nice. Kate, I will add to that I think that this is the most critical conversation that exists in all of finance. And I mean that. I don't overstate that. All the things that Michael and I like to talk about, how the advisor manages the end client's risk, has everything to do with outcomes. We can do our job right as PMs, my former job, and we can deliver outstanding returns, which I'd like to think I did. But if the client makes the wrong decision, the advisor makes the wrong decision, it doesn't matter. It doesn't matter. All of that brain trust, all of that execution, even Buffett would suffer if somebody sold Berkshire Hathaway shares at the wrong time. This is the most key conversation for delivering outstanding results for end clients. It has to be done. And I think it's done via dialogue. And I think that one of the things that can be done, by the way, it's a subject in Return to the Active Manager that my co-author Tom Howard authored a section on that, how to have these conversations. I would encourage you to look at it. I think it's pretty good. But one of the things we can help clients with is the data. All right, there is lots of data about the long-term results of portfolios that are more lean toward riskier, quote unquote, assets. And that risk, by the way, is typically defined by these concepts of beta and standard deviation. And sadly, they have made it to our end clients. And they now think it means, I've heard clients say, well, that stock's high beta. Why is it in the portfolio? It's like, so we now have a double problem. We have to disavow them that beta is relevant, but then we still have the risk conversation remaining. Anyway, the point is, there's a great paper out there. I think it's called The Return on Everything. And the researchers looked across the globe where there was good data going back to the 1800s, and they looked at the return on equities, they looked at the returns on real estate, they looked at the returns on fixed income, and they looked at the returns on cash. And they also, fortunately, calculated the standard deviation of return on this. And guess what? The standard deviation is higher for stocks. But to have invested based on Sharpe ratio or Trainer ratio would have been the difference between, at the end of the 100 and whatever year period, I think it's like 160 years, it's the difference between having $100,000 and like 10 million. It's insane. And so the real risk is you don't attain your goals. The real risk is you've left money on the table because you've indulged. And I know it's tempting as advisors to indulge our clients' risk because we want them to stay our client. Anyway, the real risk is not performing. And
so we've gone in a direction that I think we all really can be helpful if we acknowledge. Our clients are our partners in a large way. They're partnering with us to help them. Fine. But as a partner, they can hurt us, right? If you've got a client that's a very big part of your business and they leave, you're hurt. Your business is hurt. They're your partner. Do you see them as a partner? Do you treat them as a partner? This is an important topic. There's no money manager I've ever met when I bring up this topic that said, if I ask if half of your shareholders leave, would that damage your portfolio management? And they say, yes. So here's the real challenge. For private wealth, this is so simple. Private wealth, you know your clients. Institutional money management, sometimes they don't know their clients. And that potential disconnect can be incredibly harmful.
Yeah, and Michael, I'm happy that you interrupted me, but I had one more thing I was going to say, and that is advisors and institutional investors, we have to be prepared to say no to our clients, and that no must include that they may walk away from us. I think at the institutional level, this is especially true. One of the bleedings of alpha out the door at most firms is the refusing to manage money the correct way to earn return because we would prefer a marginal dollar of assets under management because of our business model. Our business model is the management fee, and it leads us to make poor choices. We ought to be able to say no to a client who does not agree with the way we manage money. And I think private wealth, it's equally true. If after all these conversations are had, and after all the research on their past actions in different market cycles and contexts is revealed, if they are still unwilling to trust you, I think you have to let them walk. I really do.
And what this means is interview your prospective clients. Only take on clients that you think would be good partners for you. This is not talked about enough, and it really matters.
Think win-win or no deal, bottom line. So I don't see any other questions. We'll pause for 10 seconds here. If you have additional questions, chat them in, or you can actually take take it off mute too on your mic. Typically, we ask you be on mute while we're speaking, and then we hold questions to the end, but you can also go off mic if you would like to.
We have a small friendly group. Let's chat if you wish. Out loud, I mean, not in the chat box.
And if not, we will adjourn for the day with a little housekeeping. I don't see any questions. Another one may come in here. Our next podcast is in exactly 2 weeks. We do these every other week at the same time. It's always noon Eastern, 11 Central. For that forgotten time zone, the mountain time zone, that would be 10. Anyway, I'm a mountain boy. In any case, we have not decided our topic as of yet, but it will be noon on the 10th of September. Same time. You can subscribe to us on From the Research Chair. We're always willing to hear and entertain your questions, your comments. So far, it's been pretty good.
Yeah, we do take requests, but neither one of us sings. So just understand.
And with that, if there's nothing else, we will adjourn for the day. Thank you, everyone.
Bye, all. Thank you.
Oh, Alam says, okay, Alam, thank you for today. You are welcome, sir. Take care, everyone.
Bye-bye.